When filing your taxes, an innocent mistake some people make is just choosing the wrong filing status. However, this could cause you to pay way more taxes than you need to, along with taking advantage of fewer tax deductions and credits than you actually qualify for. And not only are the federal tax brackets different for each filing status, but standard deductions and some tax credits are also very different for each filing status. Now, before we go any further, gotta say this compliance disclaimer. Just a reminder that we're providing this content just in general, and it's not intended as tax advice. Please check with your tax advisor about tax matters specific to your situation. That is true. It does depend on your situation. So, a taxpayer's filing status typically depends on whether they are single or married on December 31st, which determines their filing status for that entire year. More than one filing status may apply in certain situations. If this is the case, taxpayers can usually choose the filing status that allows them to owe the least amount of tax. In this video, we'll cover how you can decide which filing status might be best for you. We'll cover the 5 different filing statuses, who they're best suited for, and the different pros and cons of each. We'll leave timestamps in the description below and also a tax calculator that you can use to figure out a rough estimate of what you would pay with each filing status. So let's get started. All right, single filing status. Single filers are people who are unmarried or legally separated from a spouse under a divorce on the last day of the year and who do not qualify for any other filing status. It's important to know that while you may be married, the IRS will consider you unmarried if you did not live with your spouse for the last 6 months of the tax year. Before deciding that you'll be filing as a single filer, be sure to check whether or not you meet the qualifications of a qualified widower or head of household. Most of the time, filing under those statuses will result in a lower tax bill. So you may be wondering if there are any benefits to just filing single. Well, if your income puts you at the highest tax brackets, you could end up paying fewer taxes compared to married couples filing jointly. Suppose you and your partner were both single filers and each make $500K a year. Since the highest tax bracket, 37%, starts at around $540K, you would be in the 35% tax bracket. However, if you and your partner were married and used the married filing jointly status, your combined income would push you to the highest tax bracket, which starts at around $648K. In this scenario, filing single would save you and your partner about $17,500. Obviously, this whole situation is very rare and it's not that simple, but it's worth mentioning just to point out the difference. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Head of household. The head of household filing status is typically for unmarried people who pay more than half the cost to maintain a home and provide most or all of the support for at least one other person. The goal is to help single parents or people with dependents keep more money to pay for the additional costs of maintaining a home for a qualified person. The main benefits of filing with this status is that it allows you to claim a higher standard deduction and be taxed therefore at lower rates compared to filing as a single taxpayer or those who are married filing separately. So here's how filing as this status can save you money. For the 2022 tax year, the 12% tax rate applies to single filers with taxable income between $10,276 and $41,775. However, if you file as a head of household, the 12% tax rate applies for taxable income between $14,651 and $55,900. So if you hypothetically had a taxable income of, let's say, $100K, you would pay $14,768 as a single filer and $11,849 as a head of household. It's almost $3,000 less in taxes just by filing under a different status if you qualify for it, right? In addition, the standard deduction for heads of household, which is $19,400, is significantly higher than single filers and married filing separately taxpayers, which is $12,950. If you don't know what a standard deduction is, don't worry. We'll do a quick crash course on both standard and itemized deductions. We'll also have a longer video we'll link out in the future, so hit subscribe. A standard deduction is a fixed amount of income that is subtracted from your taxable income. This amount is based on your filing status. Itemized deductions, on the other hand, also reduce your taxable income, but vary from taxpayer to taxpayer. To decide whether to itemize or just take the standard deduction, you would likely pick the one that would result in the lower overall taxable income. If you use an online tool to file your taxes, this is usually done automatically for you. So what are the exact requirements to be able to file under the head of household status? According to the IRS, there are 3 requirements that you must meet. First, you must be unmarried or considered unmarried on the last day of the calendar year. The IRS considers you unmarried if you're not legally married or your spouse did not live in your home for the last 6 months of the calendar year. It's important to know that your spouse is still considered to be living in your home, even if they are temporarily absent due to special circumstances such as military service or business. The second requirement is that you paid more than half the cost of maintaining your house, and that house was your child's main home. The cost of maintaining a home will include the property taxes, mortgage interest or rent, utility, regular repairs and maintenance, property insurance, food, and other household expenses. The third requirement is that a qualified person lived with you in your home for more than half the year. Typically, that can be a child under 19 or under 24 if that person is a student. However, the qualifying person does not have to be a kid or a young adult. It can also be your parent in that case. They don't actually have to live with you in order to be a qualifying person. You just have to prove that you provided at least 50% of their support. Qualifying widow or widower with dependent child. This status is for people who recently lost a spouse and are supporting the child at home. If your spouse died during the tax year and you could have qualified for the married filing jointly status before their death, you can file jointly in the year that your spouse died. And don't worry, we'll talk more about the married filing jointly status later in the video. After using the joint status for the first year, for the next 2 years, you can use the qualified widow or widower status if you have a dependent child. However, if your kids are not living at home when your spouse dies, this status likely will not work for you because your dependent child needs to be living with you. You'll also have to provide more than 50% of the cost of maintaining the house during that tax year. The benefit of filing as a qualified widow or widower is that it'll let you file and receive benefits as if you were married filing jointly. This can give you a substantially higher standard deduction and better tax brackets compared to filing as a single filer. Married filing jointly. Married couples have the option to file jointly or separately on their federal income tax returns. The IRS strongly encourages most couples to file joint tax returns by extending several tax breaks to those who file together. In the vast majority of cases, it is best for married couples to file jointly, but there may be a few instances when it's better to submit separate returns. It's important to know that choosing either filing status over the other does not necessarily reflect the state of your marriage or how committed you and your spouse are to each other. So if you send this to your spouse and say we should file separate, don't look too much into it. Sometimes, there will just be one filing status that will be the better decision for your financial situation. For most married couples, filing jointly is almost always going to be the easier filing status and will typically give you a larger tax break. You and your spouse will report your combined income and deduct your combined deductions and credits all in the same forms. Super simple. You can also file a joint return even if one of you don't have any income or deductions. Also, as we mentioned before, if your spouse unfortunately passed away during the tax year, the IRS does still consider you married for the whole tax year, meaning that you can still file jointly for that year. So let's talk about the benefits of this status. When you file married filing jointly, you can take advantage of numerous tax deductions and credits that are unavailable when filing separately. For example, depending on your eligibility, you could use the earned income credit, tuition credits, student loan interest deduction and other education credits, child care credit, credit for the elderly and disabled, and many more. In addition, if you receive Social Security and live with your spouse at any time during the tax year, it is possible that you'll pay more tax on this benefit if you file separately than if you file jointly. When filing jointly, the income thresholds that apply to each tax bracket are lower than for those filing separately. This can be incredibly beneficial for married couples where one has a significantly higher income than the other. For example, a married separate filer with an income of $125K in the 2022 tax year would have to pay a top tax rate of 24% and around $21,000 in federal taxes. On the other hand, joint filers with a combined income of, let's say, $125K would fall into the 22% tax rate and pay just $13.6K in taxes. This couple would need a combined income of $160K to owe the same tax as the separate filer in this example. There's some pretty big tax savings when filing jointly. Another benefit of filing jointly is the ability to make IRA contributions at higher income brackets when compared to filing separately. So for instance, to contribute to a Roth IRA in 2022, single tax filers must have a modified adjusted gross income of $144,000 or less, which is up from $140K in 2021. If you're married and filing jointly, your joint adjusted gross income must be under $214K. This can be pretty beneficial if one spouse earns more than the single filer's limit and the other either doesn't work or makes significantly less. While filing jointly is still better for most, there is a good income tax calculator we'll link below to see what is better for your family. Married filing separately. All right, so we've talked a lot about how good filing jointly is, but when does filing separately actually give you more benefits? First of all, it's important to know that, again, filing separately is not the same as filing single. Only unmarried people who can use the single tax filing status and their tax bracket range are different. In some rare situations, filing separately may help you save on your tax return. For example, if you or a spouse has a large amount of out-of-pocket medical expenses to claim, and you and your spouse each have high individual adjusted gross incomes, you may consider filing separately. This is because the IRS only allows you to deduct the amount of these medical costs that exceeds 7.5% of your adjusted gross income. And simply due to the math here, you may receive a larger tax break when filing separately. For example, if you have $10,000 in medical expenses and made $50,000, that would meet the 7.5% threshold. Whereas if together, filing together, you make $135,000, this would disqualify you from claiming these medical expenses. Another consideration for filing separately is that your risk of being held responsible for your spouse's financial troubles, audits, or taxes might be lower. So if you're concerned about your spouse's financial condition, whether that be student loans, debt, large tax liability, or even potential tax evasion or fraud, you should consider filing separately, as filing separately will not make you responsible for the information on your spouse's taxes or other debt. Although, if this is the reason that you're filing separately, there's probably some bigger problems to deal with here. All right, so that wraps it up for this video. I hope this helped you decide which tax filing status might be best for you and your family. Thank you for watching, and please don't forget to hit that subscribe button. See you in the next one.